Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good buddy, an Austrian economist, PhD extraordinaire, Bob Murphy. Thanks for coming on, Bob. I appreciate it.
Oh, thanks for having me, George. Glad to be here.
And now, okay, so first, what I want to do is I want to read you a quote from Jerome Powell.
Okay.
And I want to get your take on this. Let me go over, and you'll have to bear with me. I'm going to read this so I can get his specific words. And this is according to the New York Times. The chairman of the Federal Reserve Board has given Congress an upbeat view of the U.S. economy, predicting that unemployment was likely to remain low over the next 2 years as inflation declined slightly. And I want to go down further here. I think you'll get a kick out of these paragraphs in this specific quote. It says, in contrast to the changing moods on Wall Street, the Fed expressed a broad satisfaction that the nation remains on track for a soft landing, quote unquote. The modest slowdown in growth that would reduce upward pressure on prices without aggravating unemployment. And now here's a quote directly from Powell. The U.S. economy appears to be making a transition from the rapid rate of expansion experienced over the preceding several years to a more sustainable average pace of growth. So now, before you give me your opinion, I want to mention that in fact was not Jerome Powell. That was Ben Bernanke in 2007.
I thought you were going to say it was me. And I was like, what, did I say
that? No, but I just did that for a YouTube video. I thought you'd get a kick out of that because it's exactly what they're saying right now. And I'm not saying that predicts that we're going to have a hard landing instead of a soft landing. But what that does tell you is that the Fed's ability to predict the future is extremely poor if there's not an inverse relationship there.
Well, yeah, I guess the only caveat I would put in there is they may know full well that they're managing expectations. Right. You know what I mean? Right. Like and it would be weird to know that, I got to be real careful when I go give a press conference because if I say, if I sneeze, that's going to cause the market to crash kind of thing. You know what I mean? So I think that must mess with your head and like change what your value system is. Because I don't know if you've noticed, but there's a lot of ex-Fed shares that once they get out of the job, they actually become good economists again. Like Bernanke sounds a lot more reasonable pre and post being, at the Fed. So
yeah, and same thing with Greenspan, right?
Right. So there is that element to it. So in other words, they may know full well, it's going to be a hard landing, but we can't cause a panic. Just like you could imagine if the Pentagon knows, the aliens are coming and we can't stop them, they might not be forthcoming. So
and I know they definitely think about psychology. I remember reading a paper from the Fed on the predictive ability of the yield curve. And their conclusion was that it really doesn't predict anything, but it creates a recession because people believe that it has predictive power.
Oh, really?
So their conclusion was that the market sees that, or market participants, or the average Joe and Jane, sees that the yield curve is inverted, and then they get freaked out because they think that there's going to be a recession, so they spend less. And that reduction in aggregate demand is what creates the recession. It wasn't the fact that the yield curve has any predictive ability.
If you can dig that up afterwards and send that to me, because I've done a bunch of stuff, and that's actually what reassures me. I mean, reassures not the right word to use in this situation, that I do think we're not going to have a soft landing, not just because of my Austrian views, but I'm like, a perma bear or something like that. But as I'm sure like the 10-year 3-month yield curve measure has been inverted since October, and it's like the most inverted it's been in 50 years, something like that.
Yeah. Well, I just did a video on this as well. And when Bernanke said that in February of 2007, the 3-month and 10-year had about a 60 basis point inversion. And now it's about 1.2%.
Yeah. And which I was just looking at how long has it been inverted. And it took one of my podcast fans sent me a note saying, what does it mean that it's like double the past 4 times, the past 4 recent. I was like,
Yeah.
I said, wow, I don't know. I got to think about it. I didn't realize that. I wasn't looking at like the magnitude of it. I was just looking at the duration or the longevity of it. But also too, I'm sure your listeners know this, but that's what's so funny about that quote you or the ideas that they're just dismissing it. Oh yeah, it's just like a self-fulfilling prophecy or sunspot theory. Is
Yeah.
that the people that were looking at this in the 80s, like it was a phenomenon, and then like people had to actually notice the pattern first, and then it was a puzzle. Like, why the heck should this be true? So it
Mm.
wasn't like, oh yeah, everyone just knows this is the case, and it's just because everyone thinks it's going to happen that it's a self-fulfilling prophecy. Like it was a puzzle that then grew in popularity. So it clearly, like for the man on the street to know that that's a thing, obviously it must have been a thing beforehand, and people are trying to figure out why.
Yeah, and also the idea that the man on the street has any clue what the yield curve is, I think
Right.
is kind of ridiculous. But I think the overall theme of the post was that we should dismiss the 2s and 10s and
Mhm.
even the 3-month and 10-year and focus on this super esoteric like metric that the Fed uses on
Uh-huh.
like the it was something. It has had a really weird name, and anyway, but I think that was just. But within that, they're saying how this doesn't matter because it's just the public sees this and their behavior changes due to this
Mhm.
yield curve inversion. And if we could just get rid of this chart altogether, it would like eliminate the recession.
Wow. The only
So,
thing we have to fear is fear itself, right? Yeah. For people who don't know, because I know I might have some of my people, because I tweeted this out listening. So if you've been beating your crowd over this, then I apologize for the redundancy. But yeah, I mean, when we talk about the predictive power of the yield curve, it's really good, like in terms of
yeah,
macro indicators. And there's both in type 1 and type 2 errors. In other words, there hasn't been a recession where there wasn't a yield curve inversion, and when there was a yield curve inversion, there always was a recession, and like even the near misses kind of thing, depending on how so you got to define it a certain way. Like if it just
yeah,
inverts for one trading session, that doesn't count. Like there's got to be a certain duration or whatever for to say this is what we mean by a yield curve inversion. But it's not like bending over backwards to really make it fit. Like if you just look at a basic, go to the Fed, the St. Louis Fed website, folks, and just type in 10-year minus 3-month, and they have that as a separate series. You can just see right before all those gray bars going back, to the 50s is how far back that series goes for
hmm
them. And it's inversion, every time. And it's so by that metric, we should be due for an official recession, maybe by the end of this calendar year, or possibly depending on the specifics, early 2024.
yeah.
But it would be a big, this time would have to be very different for there not to be a recession coming.
Yeah. Have you given any thought to the magnitude of the inversion? Because, we are talking about how 60 basis points, now
Mhm.
it's 1.2%. And you had a listener say, "Hey, Bob, what does this mean that it's so inverted?"
Right.
Have
Right.
you given that any thought? And do you think that implies that there's a hard landing compared to maybe a soft landing?
I mean, that's my intuition. And so I guess so this isn't mere I'm coming from the Austrian School of Economics, and so we don't like to just look at data, and you want to have solid theory. And so what I did is reconcile this pattern with standard Misesian business cycle theory. And it does make sense, correct? Because in the boom, the central banks flood money into commercial banks are following suit, and they're expanding credit, artificial interest rates get pushed down. But if you be more specific, that's kind of how the standard Austrian story goes. But then to be more specific and say, well, which interest rates? Well, it's the shorter term ones that are more malleable and that, bank
Mm,
policy has more effect on. And so that's, a quote, normal upward sloping yield curve would be in the midst of a boom in the Austrian framework. And then the bust happens when they chicken out or whatever, and they slam on the brakes. Short rates rise above long rates. And that's what distinguishes, like if you read Paul Krugman, how he explains the yield curve inversion, his theory is internally consistent, but it just doesn't fit the data, because his theory is that, people know that a recession's coming. They predict the Fed's going to raise rates in the future. Um, or sorry, they're going to raise rates in the short term and then lower rates down the road because we're going to be in the midst of a recession.
yeah.
And then that's what causes long rates to move around and causing but in practice, that's not what happened. Like going in and when the housing bubble crashed, it wasn't that long rates fell off a cliff because everyone saw that there was a crash coming. It was that short rates went way up. And that's why the yield curve inverted, was because short rates rose above, which totally fits the Austrian story that it's the slamming the brakes. So if that's generally correct, then yeah, my intuition would be the more the yield curve inversion there is, then that means the more like either the prior boom was really inflationary and or they're really slamming the brakes hard, which would lead you to think. So it's actually probably better from a long-term perspective if you're an Austrian sort of sound money person to think, no, they're just pulling the Band-Aid off fast, as opposed to, trying to trickle it out. But in terms of like how bad will the recession be right in the beginning, it's probably going to be worse than your typical recession.
Yeah, although there's no way to really time it. That's the thing. That kind of takes us into one of the things I wanted to discuss. And, back probably 2 months ago, I stumbled upon some charts, and it's on this website called longtermtrends.net, I think. And I started and they have got data going all the way back to like the late 1860s as far as CPI, M2, and nominal GDP. But then I took a calculator and I could figure out what real GDP was. And you can do like cumulative totals for any time sequence you want. So if you want to just look at a 5-year segment and compare like, let's say 1895 to, to 1995 or something, you can do that, or you can do like 30-year. And I got to playing around with it. And one of the conclusions, or one of the hypotheses that I had, was that there wasn't a fixed rate of, or there wasn't a fixed relationship between M2 and CPI. And because I was trying to look at it from a standpoint of sound money, because in my view, sound money might not have been a panacea, but it would be a significant tool that we could use to decrease the size of government, and then also to bring about an economy where deflation, productive deflation, was far more likely. But then I looked at like the time span between, let's say, 1870 and 1900. And then I looked at like 1930 to 1960, 1960 to 1990, 1990 to 2020. And I saw that there was a few times there, starting with 1870 to 1900, where M2 went up by 400%, right on the nose. But each 30-year sequence had a much different level of CPI, to the extent that in the 1800s, M2 went up by 400%, and they had 45% deflation during that time frame. And then you take it to the highest level of CPI, which I saw with that amount of increase, which was 1990 to 2020, about 400% M2 money supply growth, and then about 100 and, my memory serves me, like 125% inflation. And so I'm like, how can I reconcile these two things? So I started going through it, and I started looking at government spending and all. And the conclusion that I came to, and I'd love to get your thoughts on this, is that it might, because there wasn't this fixed relationship between M2 and the CPI. The only fixed relationship that I found, and again, who knows, this could just be correlation, was that as government spending as a percentage of GDP increased, it seemed like real GDP decreased. And as real GDP decreased, if you had the same amount of increase in M2, then the CPI would be higher, right? So let me just say it another way. In the 1800s, you had 400% increase in M2, but real GDP went up by 300%. And that's when you had the CPI at negative 45 cumulatively. But then moving forward to, let's say, 1990, a more recent time frame, you had that same 400%, but real GDP growth, if my memory serves me right, was only like 75%, much, much lower than we saw in the 1800s. And I thought, okay, well then I would expect CPI to be a lot higher if the relationship that we should be focused on isn't necessarily just M2 money supply growth, but more so the delta between M2 and real GDP. And then if that's true, and if you can conclude that real GDP does go down or is likely to go down, the more government spending we have as a percentage of GDP, then that's what we should really be focused on, instead of just trying to restrain the level of M2 growth. Does that make sense? And if so, I'd love to get your thoughts on that.
Okay, sure. So, yeah, it wouldn't surprise. In fact, it's like that would be standard theory, right? You would expect that, especially over long stretches, that changes in the quantity of money, roughly speaking, divided by changes in the growth and real output would correspond to what happens to nominal prices,
Yeah,
right? So if the
I
number
think
of
that
dollar,
was
if the
wasn't
number of
that
dollar
Friedman
bills
things?
double and the amount of real output doubles, even if people's cash, desire to hold cash is still the same, you would expect the prices to be roughly the same, right? Yeah, there's twice as many dollar bills floating around, but there's twice as much eggs and whatever, and so the
Yeah, yeah,
price per unit, you
yeah,
would think that would roughly cancel.
yeah,
Also, too, it gets tricky when you're looking at like older time period because like as the monetary economy expand, if there's people that used to just like farmers or whatever out in rural areas in the year 1800 didn't use a lot of cash to settle transactions, but then that became more popular. That could be a factor too. If you're talking like, 1800 to 1880 or something, there could be things
yeah.
like that.
So I don't want to disrupt your train of thought,
Yep.
and I want to circle back to that. So I'm going to write that down, and as soon as you get done with your thought, we'll revisit that. So go ahead. Go ahead,
Okay.
Bob.
Oh, I see. You're saying you want to touch on that, but okay. I thought
Yeah.
you were going to ask me something. I guess you're saying.
No. I don't want to ruin your
Okay,
train of
yeah.
thought.
So that I totally agree with. And then, yeah, as you're saying, is a separate matter. Then, so the issue though is like if we're in the midst of something and oh wow, Fed policy changed, or we're just happen to look and gee, in the last 6 months, M2 growth is through the roof, historically speaking. What do we think that's going to mean for prices of gasoline and eggs and stuff over the next 3 months? So, it's right that we could say ex post, oh, looking back, we can see what happened to real GDP and but if you're trying to like use it predictively, it's easier in real time to figure out what's how's the quantity of money changing versus, infamously, it's hard to predict, the Fed can't tell you until way after the fact whether a recession started or not. So that's why in practice, even though you're right, that's a much better theoretical mechanism. That's why they don't tend to do that. Is
Yeah.
because if it's trying to guide us and help us anticipate what's CPI likely to be next month, it's much easier to guess what's going to happen with M1 and M2 than it is to guess, well, what's real output next month going to be.
Do you know if that's what Milton Friedman's position was? I kind of remember hearing him say, because he's always quoted as saying inflation is always and everywhere a monetary phenomenon. But I thought that he specified that it was more so that relationship between M2 and real GDP. Am I right there? Am I just
Well,
kind of making that
like
up?
I said, because what I'm saying is pretty basic in terms of economic theory, like, inflation's too much money chasing too few goods. So
Yeah,
even
yeah.
in that formulation, it's got the goods in there. So yeah, and I've heard Friedman kind of elaborate a bit. And so really what he is willing to die on the hill of is to say throughout history, whenever there's a really big change where prices aggressively go up,
Mm,
it's not because there's a famine or an earthquake or something. It's because the government was running the printing presses.
yeah,
Right.
you're
But in
right.
terms of yearly, oh, why was CPI inflation 6.2% this year and only 4.8 the next year? There could be all kinds of moving, bells and whistles to explain that particular discrepancy. He's talking about really, big moves. That's the one that, and because again, it's when you get stuff like, oh, 1,000% inflation, that's not because real GDP's growth changed that much. You know what I mean? It couldn't be.
Yeah,
It's
right.
not that
Yeah.
the economy shrank 90% or something.
Yeah, at a certain point, you cannot create goods and services that quickly.
Right, or if we're talking about inflation, so inflation obviously would be if the production went down. So yeah, to
Right.
get these crazy hyperinflation numbers, it would have to be real output fell 99.999% or something,
Right.
and
Yeah. Yeah.
everybody would be dead.
Yeah. Okay. So the next kind of idea I had based on that premise was okay, if there's not this fixed relationship, if there are other variables that are extremely significant, maybe those other variables are even more significant. And if we really want small government, if that's the goal, like a limited federal government, let's say, it is sound money a panacea? Because on social media and in a lot of the space, and this is what I wanted it to be.
Mm-hmm.
Honestly, I wanted sound money to be a panacea, but I thought about it. I'm like, well, wait a minute. If it has more to do with the government spending as a percentage of GDP, what if we were in a world where we had sound money, but yet society favored larger government or more government spending or more intrusive government? Could we run into a position where we could still get consumer price inflation? And then I kind of had this thought experiment that I tweeted out the other day. I asked the Twitter people if you would prefer fiat money system with a society that favored small government, or would you prefer sound money in a society that favored big government?
Mm-hmm.
Which do we think would produce or would have the greatest probability of producing that productive deflation that we all know is most beneficial for society at large and the poor and middle class? What do you think about that thought experiment, and where are my blind spots here?
Okay, so if you're gonna say, yeah, like if that's the choice and it's realistic to assume that they stay in their lanes and that you could have a society where the government has fiat money and they have a monopoly on the legal currency and or tender and so forth. But then just culturally, yeah, the government shouldn't have anything to do with education and roads. That should all be funded by private tolls. And what are you talking about?
Yeah.
That's and
Yeah.
even let's say have private security forces. You don't need a bunch of cops walking the beat. Sure. I guess though it would be given the government though the printing it's hard because it seems free, so it would be hard to resist the government expanding whatever services are considered legitimate because it's easier. Like that's the whole point. And that, like, just to give a quick example,
Yeah.
the people who are anti-war and link it to the central bank, and I saw it like one of the Libertarian Party chapters tweeted out, get rid of the Fed, then get rid of the wars or something, meaning like one would follow the other, or without the Fed, there couldn't be the war, something like that. And somebody was, said, well, no, I mean, the US government went into war before the Federal Reserve existed, and blah, blah, blah. And it's like, yeah, okay, but, more charitably, like in World War I, all the major belligerents went off the gold standard. The US
Yeah.
stayed most faithful to it, but even they, limited like how much gold you could export and stuff like that.
Yeah.
And that was a reason. And so there were, if you read accounts, certain strategists thought World War I was going to end after 3 months because it's just too expensive. But that's because they were doing gold standard thinking. And then, once they went off gold, then they could just keep accruing debts and printing money and so on. And their currencies got crushed. So that's the idea that if the government had to pay for its expenditures, either through explicit taxation or, honest borrowing, but it couldn't debase the currency, that would limit. So yes, if the public really liked their welfare state, and I'm sure, Sweden or whatever would have a bigger welfare state, even with sound money, than the US with sound money. But the idea is it just seems so much cheaper, even though it's not. Like the public still pays for it or indirectly through monetary inflation, prices rising. But so to answer your question, I'm just saying, I think in practice, the idea is it would be unrealistic to assume it would statically stay like that. It's not a stable equilibrium.
Yeah, the conclusion I came to, or one of them, is sound money would likely constrain the government, or constrain the Federal Reserve, however you want to look at it, but it might not lead to small government. And the way I kind of got there was I looked at first and foremost the tax receipts as a percentage of GDP.
Mm-hmm.
And I looked at federal spending, and then I looked at state and local, when I was going through that. And then I saw just kind of this notch up higher and higher and higher. And in that same chart, it showed you what percentage of that spending was coming through actual taxation, so you could see the deficit. And prior to 2000, let's say 7 or something like that, there wasn't that big of a deficit. I mean, the deficit was big, but that was an accumulated thing. If you look at it year over year, you can see how, if the federal government is collecting 18% of GDP in taxes, and then let's just say you've got another 15% state and local, state and local, they're having to either tax or borrow from existing money. They don't have a Fed to monetize that debt. So I thought to myself, right there, that takes us to, say, 30% of government spending as a percentage of GDP. And I thought, would I consider that small government? I'm like, no. I mean, for me, that is suboptimal. For me, what would be optimal would be back in the 1800s when it was less than 10%. Call it maybe 5, 6% prior to the Fed. So that to me would be an indication or a proxy for limited government. And anything over 20%, when we're getting up to 30, 35. And then I thought to myself, okay, could we get there just strictly with taxation? I'm like, shoot, we're almost already there. And that's with no money printing whatsoever.
And you're saying that's because that's the state and local which don't have recourse to the
state and local. And as voters, we're voting for the government to tax us, the federal government, to tax us at the tune of 18% of GDP per year. So assuming that the federal government is going to spend all the taxes they're collecting, that means that at a very minimum, at a federal level, we're going to be at 18% government spending as a percentage of GDP. Plus, you've got to add on the state and local. And that's why I'm thinking, yes, it might constrain it, to your point with wars and whatnot. But I don't know that it would inevitably lead to enough constraint to create a limited government where, it's less than 10%. If we can look at American society today and see that we, the people, are voting to have them borrow, or we're either giving them the money through borrowing. But even if you just take the taxes alone, that still puts us at a point where we're, call it, north of like 25%.
Sure. So I guess what I would say then, like in response to your original thought experiment, is that I think sound money is a necessary but insufficient condition for small government.
Right.
That if you don't have sound money, it's unrealistic to assume you're going to contain the government because it's going to be so easy for them to bribe people. Because even if 90% of the public doesn't want something, if the government can just print money and hand it out to the 10% who do, it's going to be hard to restrain them if it looks, like, oh, it's not us. It's just prices are rising. It's those greedy unions, or it's the OPEC or whatever,
Yeah.
It's not, if you're not being taxed and you can't even point to official government debt to explain, why is this happening, then the spending seems like it's not having an effect. But you're like you say, that's not enough. I do think though there is like a feedback mechanism where, so for example, it's I think that given that they have the Fed there waiting in the wings to monetize the debt, that allows the federal government, the Treasury, to issue more debt into the private sector at lower interest rates. Because for one thing, there's a secondary market and the Fed does buy it, but even there, people know that it could if it had to. So that's why, treasuries are considered, quote, the safest asset in the world, because everybody says, oh, push came to shove, they can just print more dollars. And that's where the MMT people are coming from, that it's always just a political choice if they want to default or not, as opposed to a private company that might just not be able to pay off its bondholders.
Yeah.
Whereas, the Treasury can always just have the Fed print money if they had to. And so, given that they have that recourse where there's no, even the last vestiges of the gold standard dead, I think that allows the Treasury to borrow and spend more. And so in terms of expenditure, so to your point, you could still say, but still, why is the tax component so big? And I guess it might just be, once the spending gets out of control, they do have to kind of raise taxes and to follow suit, just to make the interest payments and whatever, to keep things from getting completely crazy.
Yeah.
But I still do think, then also too, I realize this is a little bit, appeal to psychology, but there was something that happened right after the bailouts in 2008 where, like, there were TV commercial or radio commercials I would hear saying stuff like, hey, it's time to get your bailout. Come down to Jim Honda and blah, blah, blah. And, and it's like the idea that the the Feds just bailed out the banks, so that means money's not real. Everyone just free money,
Mm,
and I
I
think
remember those. Yeah.
like it really messed with people because for a while they were worried and they were listening to people like me. And I don't know if you were, and I was concerned that prices were going to go, and then that didn't happen. And maybe you and I want to talk about that as to why. But then it was like, okay, yeah, they can just print money and get people out of the holes they dug for themselves. And so money's not really, there's no such thing as budget constraints anymore. Maybe there used to be, but not now. And I think
Yeah.
that allows like that reduces the vigilance with which you restrain government spending if it looks like they just ran, a $1 trillion plus deficit. Like during the George W. Bush years, a $200 billion deficit was alarming people. And,
Mm.
a 300 billion would be, wow, that's really reckless, you stupid Republicans or whatever. And then, I think Obama had 4 years in a row where the deficit was above $1 trillion.
Yeah. Yeah. That makes a lot of sense. And when I say on social media that I'm kind of wondering if sound money in and of itself is a panacea. As you can imagine, I get a lot of I get a lot of venom for that one, right? And they always say, "Well, George, why do you wear that end the Fed hat?"
Oh,
and
right.
whatnot? And I'm like, "Hey, I'm not a big fan of the Fed, but I that doesn't necessarily mean that I think they have direct control over the money supply or what we were just talking about. My cardinal sin, if I'm looking at the Fed, is the manipulation of the price of money. So we don't have a market rate for money. That's number one. And number two, the bailouts, to your
Mhm.
point. I think that another thought experiment that I've tried to do is go back to when they started QE. And we know that the market just pretty much went straight up, the stock market. And but I don't know that there's a causal effect. I think it might be psychology. But what I tried to envision is if they didn't bail out long-term capital management, or if there had never been any bailouts, they just let people fail. And if they just let the banks fail, let's say in 2007, let's say that would have happened prior to quantitative easing, and then they did QE, would we have seen the same risk on type of environment in the stock market if you just had this kind of vacuum of quantitative easing? And obviously we don't know for sure, but when I kind of think through that, I'm like, I don't think we would have. I think the reason we had so much risk on wasn't necessarily because of QE, but it was more so because the market, that was a signal to the market
Right.
that the Fed has your back,
Mhm.
and the Fed is going to bail you out if need be. So just increase the size of your balance sheet to the point where you're systemically important.
Yeah, there was a period because I was going around giving a lot of talks in that period when the rounds of QE were going on, and I was very alarmed. And I found this chart. I wasn't like looking for it. I just popped out one time when I was playing around with the charts on Fred, and I was like, "Whoa!" And there was a period there where if you charted the S&P 500 against the monetary base or the total assets held by the Fed's kind of equivalent, and it was hand in glove. Like those
Mm,
two things went. It was freaky how, and it only broke down when Trump got elected. Then the stock market jumped, even though there wasn't like a corresponding boom in the Fed's asset purchases at that point.
right.
And so, presumably that's because they thought, oh, wow, we had been pricing in a Hillary presidency and now it's Trump. And so, asset values go up. So yeah, I think you're right. And then when you ask why, it's because also, too, it wasn't, I mean, they were explicitly saying, like, in terms of the Fed explaining, okay, why are we going to, start up a new round of QE or why are we going to keep this one going? They would look at asset prices, and I mean, they wouldn't say, oh, we want to help our buddies on Wall Street, but they would say asset prices are, faltering and thus, foreshadowing future declines in economic activity. And so that's one of the reasons we blah, 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 blah. And so they were, admitting partly why we're going to keep the asset purchases up is because Wall Street's faltering.
Yeah,
It
yeah.
wasn't
Well,
merely looking
Bank
at
of
like the
England is pretty
unemployment rate.
explicit
Yeah.
about the purpose of QE being to increase asset prices.
Right. And they would even use that as a sign of success.
Yeah.
Like to say, oh, how do we know QE2 worked? Well, look at what happened to asset prices. You're right. They
Yeah,
wouldn't say the stock market because that sounds a little bit too like, well, wait a minute. But to say asset prices sounds very, like, yes, that sounds good. We like
yeah,
assets.
yeah. Okay, so this brings us to another topic there. And let's move over to your paper. Or was it an ebook, Bob, or was it an actual book? The Understanding Money Mechanics.
It's an actual physical. I mean, you can get it the PDF and whatever, obviously, but yeah, it's a physical book.
Yeah, so I'd strong. And where can people get that? Because I'd really encourage them downloading it and checking it
The
out.
Mises. So if you go to mises.org and just type in in their search bar Understanding Money Mechanics, it'll pop up.
Okay, fantastic. So in this, you in chapter 12, you go over this report from the Bank of England that they had in 2014, which I'd also encourage people reading. And this is a report that I've read just like thousands of times in doing whiteboard videos and whatnot. So I'm really glad that you referenced that. But that was, you specifically reference where they say that the traditional economics textbooks have the kind of role of the central bank and the banking system in reverse order. And I think that this is really, really, really important for people to get their head around on a variety of different levels. But basically, the way we see it is the Federal Reserve comes out and they say, okay, we're going to create this many bank reserves by open market operations or quantitative easing or whatever. And then the banking system then says, okay, based on a reserve requirement, we've got this many bank reserves, so we can go ahead and create this many dollars worth of loans. And that's the way, I mean, 99.999% of people out there, even very sophisticated people, think that that's the only way it works. That's the only possibility. But they say, no, it's actually in reverse, where the banks will come out and lend. And then the Bank of England will look and say, okay, well, based on their lending practices, how many reserves do they need? And then we'll go ahead and create the reserves by buying a few treasuries here and there, some mortgage-backed securities, to make sure that they're adhering to those reserve requirements that we have stipulated. And another thing, and Josh, if you could write this down too, if Bob wants this, I can send him a link. I was reading a summary from the Federal Reserve for 1995 open market operations. And I found it fascinating that they don't come right out and explicitly say this, but the language implies that this is exactly what they were doing, even at the Federal Reserve in 1995. And I think that, among other things, kind of completely turns everything upside down to where it's like, well, wait a minute, maybe the Fed doesn't have control over, let's say, M2 money supply. Maybe it's more the banking system. And another thing too, Bob, that I thought was funny. I was listening to one of your interviews, and I can't remember which one it was. I was at the gym. This was probably a month or so ago. And you were talking to someone about like a book you read or maybe another interview. And the guy that you were referencing said, as an example, when's the last time you went to a bank and they said, you're a perfect candidate, but damn it, unfortunately, we just ran out of money. Or unfortunately, we just hit our reserve requirement. So if you could just come back maybe in a month, and then we'll have some more reserves, or maybe the Fed will be nice enough to lower the interest rate or something like that, and then we'll be able to give you that home loan. And so, like, no bank has ever said that. So you got to ask yourself why. And that's something, kind of an example that I've used many times as well. But you want to maybe start by dissecting that idea. And then I think, kind of where you might take the conversation is how, if the banks are settling on the Fed's balance sheet, then those reserves would act as a constraint. Now, whether or not the Fed is creating them as a result of lending, or lending is happening as a result of the Fed creating them, maybe that's semantics and maybe it's not. Can you kind of articulate your view on that?
Sure. So yeah, I'll be real. So the traditional view, I've taught it this way, the standard money and banking textbooks, from the 50s and 60s, this is how it was taught for a while, would just say, oh yes, if the central bank wants to promote economic growth, they will go buy assets, typically government bonds. That adds reserves to the banking system. With a statutory reserve requirement, now the banks have excess reserves. They can legally go out and make new loans to people. Those people get the loans, they redeposit it in their local commercial bank. Those reserves get over there. They make loans, blah blah blah. And then when the system is fully loaned up, There, if it's a 10% reserve requirement, then for, every $1,000 of reserves that the central bank pumps in, there's $10,000 in new money that, the reserves plus $9,000 more of additional loans that have been made that are now sitting in people's checking account balances. And so that there, like you said, that's the driver of inflation and growth, is the central bank's decision to either buy assets, which is inflationary, or it's contractionary. If they sell off assets, then it's the reverse of what I just said. And so you're right. The contrarian view comes along and says, what? That's, if anything, that's backwards. And sometimes though, they'll just say this, and I think this is a little bit wrong, or leave something important out. They'll say, no, no commercial. They look at the loan, like the prospect, the credit worthiness and whatever. Is this a good investment or not? A good loan to make? The loan department will, and then they'll go ahead and make it or not. And then they'll check, and, oh, gee, if we're short on reserves, like we're not meeting our reserve requirement, we'll just go out into the market for reserves and get what we need.
Right.
And so that, and then sometimes they just stop right there. And so
now you got to look at an aggregate total.
Yeah. So what I said in the, the book, The Understanding Money Mechanics, is I wasn't trying to say one story is right or wrong. I was just trying to reconcile the two and say, okay, but what happens? That's just a nice, so right. The individual bank, that might be how they think, but in the aggregate, the system as a whole, if banks all of a sudden, you're in an original equilibrium where the banks are all fully loaned up, and then they all make a lot, $1 billion more in loans, they need $100 million more in reserves if there's a 10% reserve requirement.
Right.
And they can't, if they're borrowing it from somebody else, well, then that person's short. You know what I mean? It can't be that everybody, is short, that can't work. And so but I said, but they do have a point, because especially if how the central bank is operating is it's announcing a target for the federal funds rate, which is just the overnight interest rate, the interest rate on overnight loans of reserves. Well, then what that means is if the banks are all scrambling because they see good loan opportunities, a bunch of them now are short reserves and they're going to the market for reserves to try to borrow them to meet the legal requirement, that pushes up the federal funds rate. And so if the central bank, their policy is we want the federal funds rate to be between 2 and 2.25%, and it gets pushed up to 3% because the banks are clamoring. Well, how do they push it back down to their target? They buy assets and put more reserves in.
Yeah.
So it's not, all you need to assume is that the central bank's policy mechanism, or the way they implement monetary policy, is by targeting the federal funds rate. And then that, the second version of the story does go through, where it's the commercial bank's activity that, sort of drives, or in other words, the Fed passively responds to the demand for reserves.
Yeah.
That's one way of putting it. So I said, you could tell the story that way. And just to your point, George, I know a guy who's very steeped in Austrian economics and happened to be a banker for part of his career. And he told me, he said, I have never been in a loan meeting where anybody said, hey, do we have excess reserves right now? He said,
that's the story. That's the story I was thinking about, Bob. That's the story that I was thinking about. Yeah. And so I wish I had it pulled up right here. I was reading it earlier, but that summary of open market operations from the Fed in 1995, it says exactly that. Basically, I think the guy who wrote it ran like the New York Fed's trading desk. And he said that they would sit there and try to determine, what bank lending was going to look like over the next month. And then they'd factor in where they want the Fed funds rate to be. And then they determine how many reserves they need to add to the system to achieve that objective based on the current trajectory of bank lending. And it's precisely what you just kind of outlined there.
Okay, well, that's good. That's reassuring, because I kind of just did that a priori when I wrote the thing. Like, I was just thinking through the logic of it, and so.
Do you want me to send you the link to that?
That'd be great.
Okay, Josh, can you write that down as well, and I'll shoot that over to Bob.
So again, just to wrap up, so both sides, they do have a grain of truth. You know what I mean? Like the original canonical textbook view. It's not that it's wrong in terms of, like, it's true. If the central bank just creates a certain amount of reserves and then they enforce the law saying you need to keep 10% of your of your demand deposits set aside as reserves, either in the vault as currency or on deposit with the central bank, that would constrain aggregate lending. That, one bank could expand, but if it's trying to borrow reserves from somebody else, then that other bank has to restrict. But again, the point being, in practice, though, if the central bank's policy is to target, in other words, if their policy isn't, here's how many reserves we're going to have next month, And, central banks typically don't talk like that. That's not what they're measuring. Although with QE, that is kind of what they were doing, is they were saying, we're going to just announce to the market, this is what we're, in terms of asset purchase, is what we're doing. But in any event, so it's not that the textbooks were wrong per se. It's just that, it is possible that in practice that was giving people a misleading view. And to the extent that business optimism or pessimism was driving commercial bank lending, and then the central bank, if it just passively expanded or restricted reserves to keep hitting its target, you could see why just the textbook view would be very misleading.
I think the textbook view was mechanically close or maybe accurate, but the takeaway, I think, is what confuses people, because the takeaway there would be the Fed is the puppeteer, right? When it comes to the M2 money supply, let's say. And the way I like to say it, like I texted you earlier, is if we're looking at the monetary solar system, most people, they look at that textbook definition and they assume that the Fed is the sun and the commercial banks are kind of the earth just revolving around the sun. But if you step back and you say, wait a minute, if the Fed is just responding to what the banks are doing, then it flips everything upside down to where there isn't that constraint really on bank lending. The only constraint is, do they have productive loans to create, or do they have credit to extend? And then the Fed is going to respond to that. And then they might try to manipulate that interest rate, but they're still going to make sure there's enough reserves to meet that requirement. Therefore, it might be more appropriate to look at that solar system as though the commercial banks are the sun, and then the Fed is kind of the earth. It's like revolving around the commercial banks. And I think, if we had another 2 hours, I could go into like countless ways that impacts or that would change current thinking in the marketplace and maybe with economists. But it's kind of base level. I think that's what I try to articulate, and that's what I try to think through.
So can I respond to that? Do we have time?
Yeah.
Okay, so I get what you're saying, and I guess just to make to give more nuance to it. So, but just to extend the thinking though. So again, where I was coming from is I understand the critics that if the central bank is just targeting like a range for the federal funds rate, then they're going to passively let the commercial banks drive what the level of reserves is going to be. But how does the central bank come up with what that target rate is? It's partly because it worries about like what's CPI doing. And so if the commercial banks are making a bunch of loans, because now we're in an artificial boom, let's say, and things are going well, and then the Fed has the target federal funds rate at 2%, and so they're adding reserves, and then all of a sudden, but now because they're pumping in all this money and banks are pyramiding on top of that because there's good loan opportunities.
Yep.
And then all of a sudden, CPI starts rising 10% a year, the Fed's going to raise that federal funds target rate.
Right.
And so ultimately still they do have the power to kill the boom or to feed it, I would say. And then if you want to say, but the commercial banks altogether have more aggregate power than the Federal Open Market Committee members, maybe we could do pros and cons, but still the Fed being one player is obviously much bigger than any one commercial bank. You know what I mean? So it's sort of like saying what's more powerful, the Pentagon or the bond market or something. And you could make arguments either way, but there's a sense in which the guy in a tank coming through your house has more power over you directly than, what happens to interest rates when people are worried about a default on the corporate America.
Yeah, absolutely. I just try to think through it in terms of M2 and asking myself, in this one entity or the combined effort of all these entities, at any given time, to your point, the Fed can really increase M2. That is, look at a war, look at 2020, when we had M2 go up by 25% or whatever it was. So there's spurts where the Fed can really matter and move the needle. But if the way I look at it is, if you look at long periods of time, the major player in the impact M2 is going to be the combined effort of the commercial banking system. And that's maybe that's a little too nuanced, but I think that has specific ramifications that again would take us another 2 hours to really think about. But and I think that goes back to if we're trying to limit the size of government, or if we're trying to limit the size of M2, if that's an objective, then if we're sitting there being hyper focused on the Fed, that might not be the best use of our time.
Okay, yeah. So one quick thing where I'm agreeing with you, and then maybe I'll disagree on a separate point real fast is in terms of the agreement. Yeah, I don't know if you saw it. I'll send you a link if you haven't seen it. But I gave a talk at Mises University recently where I was contrasting. I said, hey, how is it that the huge increase in the monetary base with the rounds of QE didn't lead to $6 eggs, but why is it with the huge pumping of money during COVID, all of a sudden it looked like the monetarists were right again, whereas before it looked like we were idiots, kind of thing. And one of the things I mentioned was that what misled me at the time is right after when the QEs were kicking in, M1 went up. And so people who were saying, oh, no, this is just all bottled up in the banks and the public's not getting their hands on this money. I was saying, no, M1. And for people who don't, M1 is like actual currency in the hands of the public and demand deposits, like, checking account balances. So saying, no, M1 it's not up as much as the monetary base, but it is way up by historical standards. So this isn't completely being contained. But what I realized later when I was looking back at it is the M2 didn't go up too much after the QEs, whereas it did go up during COVID. And so since M1 is a component of M2, I was like, well, then something in M2 must have gone down, and it was retail money market mutual funds.
Oh yeah.
And so that fell off a cliff after 2008. And so so I can see how, like there's, like the fact that people were panicked when, funds breaking the buck and whatever. So people were panicked and presumably they wanted to hoard like currency in their checking account balances, because that was the only thing that was considered, they expanded FDIC and all that stuff. And so, had I looked at the time, the difference between M1 and M2, I might have realized, oh, wait a minute, people are panicked. They're sopping up all this extra cash. That's why you're not going to see an explosion in consumer prices because the demand to hold money. Whereas in COVID 2020, that didn't happen. Like they pumped in a bunch of money and people were spending it.
Yeah. So another explanation that something might add to that is I read a paper from the Federal Reserve. I was actually researching a whiteboard video the other day, and they attributed the increase of M2 to 4 factors, but 2 main factors. And that was number 1, businesses and consumers that had access to lines of credit drew those down very, very quickly because they thought the crap was going to hit the fan. And if you're a business and you've got a $250,000 line of credit, you're like, I'm going to take that right now. Thank you very much. That was number 1. And then number 2 was and I've given this a lot of thought, and I talk about this often. It's when the Fed does quantitative easing, how does that impact M2? And if they're buying from a bank, it really doesn't. But if they buy from non-bank entities, then that will definitely impact M2. And so the Fed said that number 1, it was the lines of credit. Number 2, because for whatever reason, the majority of the bonds that they purchased via the primary dealers were coming directly off the balance sheets of non-bank entities. So you had that asset swap where the Fed, or via the primary dealer, is saying, I'll take that treasury, thank you very much, and we'll go ahead and give you this additional commercial bank deposit. And that increases the M2. So those are the 2 main contributing factors that they said went into that parabolic move in M2.
Okay. Yeah, that's good to think. Just to circle back though.
Yeah.
So I like that. On the one hand, I was sort of agreeing with you that, there's the sense in which what's happening on the ground out in the markets has more influence, or at least is a big component of what's going on. You can't just look at, statistics of Fed policy. On the other hand, though, if your takeaway is, well, if we want to constrain like the growth of M2, maybe focusing on the central bank's not the thing. My only concern with that is it's much easier to just focus, like to say something like the Fed can only increase its balance sheet 2% a year or whatever we want to say, whereas it would be harder to come up like, how would you, I wouldn't want to pass a rule saying commercial banks can only increase their loan portfolio by X% a year, kind
Nor
of thing.
would I. Yeah,
So,
nor would I.
so
No,
even though I agree, there's a bunch of moving, but like to give a stupid analogy, you could like say, well, yeah, well, sure, we can make sure when pilots are getting in to fly the plane that they're not drunk. But I mean, there's all kinds of stuff that could go wrong. There could be lightning, there could be a flock of birds, there could be, maintenance failure. And so just focusing on making sure the pilots aren't drunk isn't going to guarantee the plane's not going to crash. And it's sure, but in terms of bang for the buck, if I could just that's a pretty good thing. Let's make sure the pilot's not drunk before he gets behind, the wheel, or would you call it the wheel? I don't know, the stick. What do you call it when the pilot gets behind something in the plane?
No, I didn't communicate that very well. You can't, there's nothing that's going to be perfect, of course, but I think the least bad way to have a banking system is just pretty much free banking. Like we had in the 1800s. And I think that if you look at the 1800s, if that's, accurate, that we can conclude that the majority of that increase in M2 coming from the banks, the additional extension of credit, was going for productive purposes. And that's likely why we saw real GDP go up by 300% during that time frame. And I would argue that more recently, the majority of credit that's being extended is not for productive purposes. And that's why we see a much lower percentage of real GDP growth. And therefore, with the same increase in M2, we see a much higher rate of consumer price inflation.
Yeah, I agree with all that.
So the key there is to get the government, get the central bank out of the equation with the banks, and just let the free market manage that interest rate, extend the credit. If the free market decides they want fractional reserve lending, then that's fine. Then those banks will get the business, and that's what will happen. And then you have the highest probability of creating loans and extending credit for purposes that will most likely increase goods and services.
Yeah, I agree with all that. Ultimately the best policy, like it would be if the Khrushchev or someone came to us and said, well, what's the best way to centrally plan agriculture? And we would say, you can't. There's no good way to do it. Just privatize the farms and blah, blah, blah. And yeah, given that you're putting a gun to my head and making me pick, there's some rules for wheat production that are stupider than other ones, I assume. But ultimately we can't centrally plan it. And the same thing with money and banking, that ultimately just you got to get the political institutions out of it altogether and return to the market, and that's the only thing that's going to really work.
So on that note, I said at the very beginning I wanted to circle back here, and I know we're running short on time, Bob, and I just let me know if you need to.
I'm okay.
Cut it off here. In going over all these statistics, one of the pushbacks that I get frequently is, and you alluded to this, you said, well, GDP back in the 1800s was a lot different, or maybe M2 money supply was measured differently, or maybe, you can't look at government spending as a percentage of GDP back then and compare that to today, because the government apparatus is so entirely different that it's apples to oranges. And my comeback is I always say, well, I agree that GDP isn't perfect, number one. And I agree that it was measured differently, but I don't know that you can completely throw the baby out with the bathwater. And that just because, like, CPI is a good example. We all know CPI is nonsense.
Right.
But to say that we shouldn't even use it for any type of hypothesis or trying to think through, what's going to happen in the future, or what's happening now, or what happened in the past, I don't know that I would go to that length. I still think that CPI, as flawed as it is, still gives us a lot of good information. Maybe just the direction of consumer price increases. So, I'm just an amateur. I've never taken an econ class or a finance class or anything like that. You're the professional. You got your doctorate in economics. So when you're trying to process information and using specific metrics, do you use GDP? Do you use government spending as a percentage of GDP? Do you use M2? Do you use the CPI? And if so, how do you try to account for the fact that it might have been calculated differently in the 1800s versus today?
Okay, sure. So another thing too is, remember, there was a period, if you remember, like older textbooks, they called it gross national product,
Yeah,
GNP, and then they
yeah,
switched it to GDP because back when there weren't like multinational corporations, the difference between those two wasn't as big a deal. But then, over time, that did become more a bigger deal. Um, so for people to know, like GDP is more like what's being produced on our soil within our borders, even if it's by foreigners, running operations here. In which case, it's like accruing to their nation. But anyway.
mhm.
Um, so yeah, and this has to do, there was and I can't remember the name of it now, or who the authors were, but there was a revision even by like mainstream economists, that there was it looked like for a while, like the conventional wisdom was that some of the panics, as they called them before they called them recessions or even depression, like the panics in the 1800s were considered pretty bad. And then they ran some number and they realized that, oh no, it wasn't, because they were looking at like collapsing prices,
Right.
but
Assuming that was collapsing real GDP, right?
exactly right. Because in the 20th century, like if farm prices dropped 30% or something, then that usually meant it was a bad economy.
Yeah.
Whereas back then, and I would argue, like, so the mainstream economists didn't necessarily say this, but they just were using other tools to say, oh, the fact that, agricultural prices fell this much in this period, but if you look at these other proxies for, industrial production or whatever, it wasn't so
Real
bad.
wage growth, for heaven's sakes. Yeah.
Yeah. And so, because again, part of the issue is they didn't measure stuff as much back then, so we don't have, they have things like, commodity prices and stuff that people had to buy and sell like professionally. And so you have some good data there, but you don't have a lot of the, you don't have consumers being surveyed by the BLS or something. So they in other words, it changed what the estimates were of real GDP declines during some of the recessions of the 1800s, because again, they had assumed with our modern perspective that, oh yeah, rapidly falling prices means your economy's in the toilet. But
Mhm.
that wasn't the case back then, I think, because everything was more nimble. It was just free. And yeah, and because they were still tied to gold or silver, depending on the years you're looking at, there could be a boom and prices would rise, but ultimately it had to come back down. And so, there was that cycle. And that's why, prices in terms of gold and silver, or like $100 tended to buy you the same basket of goods over a long stretch of time. It wasn't constant year to year, but like if the dollar weakened in a certain period, then it would strengthen over time because
Yeah.
they had that peg. So, um, because of that stability, I would say, much sounder money that that so to answer your question, that you got to be careful, and yes, some of those statistics can be useful, but um newer interpretations, which are, I think, are actually more even-handed, to realize that, yeah, some of that stuff, when you look at these older data series, like in other words, if you just look at what's real GDP in 1870 to 1880, some of the earlier estimates were very pessimistic because they were just looking at falling nominal prices, when actually that wasn't reflecting what real prosperity, or you know what I mean. So so going way back, you run into that issue. Yeah, to answer modern times, you got to start with just conventional stuff. But there's even problems. This last thing I'll mention, like World War II, there was a huge issue that Bob Higgs found. You look at standard measures of real GDP, and it was awful, in the 30s. And then all of a sudden, 1940, 41, 42, 43, it just goes through the roof.
Yeah.
And everyone says, see, so huge government deficits boost the economy. And there were two things wrong with that. So one is, they were counting government expenditures, like $1,000 of government expenditure adds to GDP the same amount as $1,000 of consumer expenditure, when
Mm.
even theoretically, like, not because I'm a Rothbardian, but just even on its face, no, a coercively obtained tax dollars spent is not the same
Yeah.
institutionally as, consumers
Yeah,
voluntarily
that
spending money.
increase in GDP did not accrue down to society at large.
Right. Even again, just theoretically, like, why would we think spending money is a measurement of consumer value or something?
Mhm.
And and so that whole mechanism isn't there if it's a government expenditure, because they don't get to keep the money if they don't spend it, right? So just institutionally, the fact that the Pentagon spends $1 million on something doesn't mean the same thing as if you spend $1 million on a house. And
Yeah.
so, but then beyond that, another thing, and this is what Bob Higgs found and documented, was, so the Fed pumped in a bunch of money, or you could say the commercial banks expanded it, right? Whoever the son of the solar system was, but the money supply greatly increased in World War II, but they had price controls in effect. So
Yeah.
normally real GDP doesn't get boosted as much from just printing money and spending it
Oh,
because,
great point.
nominal expenditures go up, nominal GDP goes up. Oh, but you deflate it by the price
Yep,
deflate.
yep, yep.
But that was legally prevented from happening.
Yeah.
And they didn't adjust for that. So when you go and look at the standard, quote, historical real GDP figures or official, I should say, they don't account for that at all. And I
Oh, I
even
didn't know that.
I emailed Bob Higgs to make sure. I said, do you mean they adjusted for it, but you don't think they did it accurately, or they didn't account for that at all? And he said they didn't account for that at all. So the
Wow, they didn't
fact that,
account for price
prices
controls.
should have risen 10%, but legally weren't allowed to,
Did they do it in the
they
70s?
just, I think they account for it in the 70s. Like they might fudge it, but no, I mean, it's, I believe that they took into account the wage and price controls in the 70s.
Okay, okay.
I'm not sure, but I think they did.
Yeah, Josh, write that down. I'll have to look into that. That can you imagine if they didn't do that
That's a
in
good
the
question. I don't
1970s?
know.
Huh. And I don't know if the price controls in the 1970s were as extensive as they were in the 40s. I'd have to look at that as
No,
well.
I don't think they were by any. I think it was mostly like the energy,
Yeah. So
and even the wages that I think it was more fleeting.
so as a professional, if you were trying to compare
Mhm.
economic output or the strength of the economy today or in modern times versus prior to the Fed.
Right.
I think what you're saying is you'd use GDP, but understand that there's a lot of wiggle room with that number. Would you just try to seek out as many data points as you could during that time frame prior to the Fed to see if they
Mhm.
corresponded with with the real GDP number, to see if if 99% of the other data points that you get suggest that there was significant real GDP growth, then you can say, okay, this was probably correct. Is that how a pro would do it, or what do you think?
Well, I'm not an economic historian, but in terms of me, like looking at other people's stuff. So let me clarify.
Like if
I
you were
actually,
writing a paper, how would you do it?
yeah, I probably wouldn't. So let me just clarify. I wouldn't necessarily like. I would just to see what it shows. Yeah, I would probably look at real GDP figures as they're constructed. But since I know those are much sketchier back then, I
Yeah.
probably would try to do an apples to apples and look at. I mean, you could literally look at apple production, but
Yeah.
like iron or some more tangible thing that I know the data is pretty real, no pun intended, like authentic, I should
Yeah.
say,
Yeah.
from then to look, to see, oh yeah, steel production fell off or this much, and then looking back. So that's probably what I would try to do. But again, even there, it's tricky because if it's an agricultural economy, it's tough. But because like I say, I know that those like real GDP involves looking at nominal expenditures and dividing by a price deflator. And so if you don't have as much stuff going into that and you're constructing it differently, that could give you vastly different results. So I would try to look at stuff like that, or I'm trying to think of what other kind of proxies you could look at. But yeah, I think I would look at the conventional aggregate figures, but then I would like spot check it with some individual
Yeah.
things that are more
Yeah, another thing that I
solid.
did is I just tried to see if that correlation was consistent through different time periods.
Mhm.
And if I can see that it was, then that might add a little more validity to it, although it wouldn't be, definitive.
Right. I mean, there's things too, like with the Roaring '20s. I mean, yeah, you can look at the conventional, but there's stuff like the electrification of America and how many people started getting radios and refrigerators and stuff. You know what I mean? Like there's a lot of sort of anecdotal thing to show like there was a sense in which the '20s, at least for a certain stretch, you could see that America really did get wealthier. Like their
Yeah,
standard
right.
of living really did go up a lot. So
Yeah. All right, Bob, thanks very much. I know we were only supposed to go 45 minutes and I've kept you way over that. So what are you working on right now? Why don't you tell, I know you got the podcast, or You working on anything cool that you'd like to share with the audience?
Well, it's I'm still sort of
Other
getting
than
my ducks
raising
in a row
your
because
kids, your
yeah,
newborns?
you're right. Because yeah, I had a baby recently. My wife obviously had the baby, and we're moving from Massachusetts to Florida, so I've been a bit busy with that. But yeah, just keeping up with the podcasts and I am, in all honesty, looking at this issue of the yield curve and trying to just work through the logistics of that, and even the stuff we were talking about. Like I noticed, as I'm sure you know, maybe you've been talking about it, M2 is dropping
Yeah.
recently.
Yep. Yep.
And by the way, some news outlets are saying for the first time on record, it's like, well, no, it fell in the early 30s. Like that's Milton Friedman's famous explanation for why the depression was so bad. Um, and I'm just trying to see in the components, it wasn't retail money market funds. Those are still up. You know what I mean? So it's
Mhm.
the M1 is down too. So anyway, I'm just trying to tease through and look at and
You know what's funny,
figure things out
Bob,
like that.
I actually, I don't know if you have those, you probably don't have those notes, Josh, but Josh and I went over that in a live stream. We were trying to think that through like last week or the week prior. And I can't remember the inputs we were using, but we looked at bank credit, obviously.
Mhm.
And then we looked at, I think it was QT, and then we looked at reverse repo. And then we looked at a couple other components there, that contributed. I tried to figure out because I tried to look at the decline, and then try to look at kind of the usual suspects, and look at each one of those individually, and see if that would add up or come close to the decline in M2. And there was still a gap. I
Mhm.
can't remember what it was, Josh. Maybe you remember, but I think there was still like a $200 or $300 billion gap in just me adding up what the major contributors would usually be
Right.
based on what we've seen. So yeah. So when you come to those conclusions and the results, are you going to share that on your podcast, or where can people look for that?
Yeah, at the very least, either that or I do the podcast with Jeff Dyson. So for the Mises
What's the name of
Institute,
that podcast?
it's called the Human Action
Okay.
Podcast.
Okay.
So if it comes up, if we happen to be covering something that week that would be relevant, I might mention it there. But yeah, the Bob Murphy Show is my podcast, and certainly if I have something important that jumps out at me, that's where I would announce that.
Awesome. Well, Bob, thanks again for your time. Good luck with the little ones and good luck with the move, my friend.
Okay, thanks a lot. Thanks for having me, George.